When a startup raises capital, one of the first decisions founders and investors must make is how to structure the investment. While traditional equity financing, priced rounds, has long been the standard, many early-stage startups today opt for SAFEs. That stands for Simple Agreements for Future Equity. Both structures serve the same fundamental purpose. They provide capital in exchange for ownership in the company. However, they differ significantly in how that ownership is determined, when it is granted, and the complexity of negotiations. For founders, understanding the difference between equity financing and SAFEs is crucial because it impacts valuation, dilution, investor expectations, and long-term fundraising strategy. Equity financing, also known as a priced round, is the traditional route for startups to raise venture capital. In this process, investors purchase shares at an agreed-upon valuation, which gives them an immediate ownership stake in the company. The whole idea is that the valuation of the company is set, and both the founders and investors agree on a price per share, based on the pre-money valuation. This means investors know exactly how much of the company they own, and the number of shares in the company increases, causing a dilution of ownership for existing shareholders. When shares are issued, investors typically get preferred shares in return for their capital and the terms of the investment, such as governance, voting rights, board seats, and liquidation preferences, are all negotiated upfront. These terms are legally binding and make sure that both parties are on the same page about how the company will operate and what each party's rights are. The big advantage of equity rounds is the clarity it provides. Investors know exactly how much of the company they own, and there's no uncertainty about how their stake might convert in future rounds. It also tends to create a stronger commitment from investors, since equity holders are in it for the long haul. As a founder, it also gives you a predictable sense of dilution, making it easier to plan for future rounds. However, it does come with its challenges. The legal negotiations, due diligence, and term sheet structuring can be complex and expensive. It's also not a fast process. Equity rounds can take months to finalize, which can slow down the fundraising process. Plus, for early-stage startups with little revenue or traction, justifying the valuation can be tough and puts pressure on founders to prove their worth. For startups that have already gained traction and are looking for a more structured, long-term strategy, an equity round often makes sense. But for early-stage companies that need to move fast and stay flexible, SAFEs can offer an alternative route without the need for setting a valuation or worrying about immediate dilution. The SAFE was developed by Y Combinator in 2013 to simplify early-stage fundraising, offering startups a faster and more flexible way to secure investment. Unlike traditional equity financing, where investors receive shares immediately, a SAFE allows investors to provide capital upfront in exchange for the right to convert that investment into equity in the future, typically when the company raises a priced round. One of the key advantages of a SAFE is that it eliminates the need for an immediate valuation, allowing startups to raise funds quickly without prolonged negotiations or complex legal agreements. Instead of determining a company's worth at an early and uncertain stage, the investor provides capital now and the SAFE converts into shares later, usually at a discounted price or based on a valuation cap, if applicable. The conversion mechanics of a SAFE are structured to reward early investors for taking on higher risk while keeping the fundraising process simple and efficient for startups. There are typically three main elements that influence how a SAFE converts into equity: the discount rate, the valuation cap, and in some cases, the valuation floor. The discount rate is one of the most common features. Many SAFEs include a discount, usually in the range of 10 to 30%. This means that when the company eventually raises a priced round, the SAFE converts into equity at a lower price than what new investors are paying. For example, if the startup raises its next round at $5 per share and the SAFE includes a 20% discount, the SAFE investor would convert at $4 per share. This allows the investor to receive more equity in return for their early investment. The valuation cap is another important element. It sets a maximum price at which the SAFE will convert into equity. This ensures that early investors are rewarded for their early commitment, even if the company's valuation increases significantly before the next round. For instance, if a SAFE includes a $10 million valuation cap and the company raises its next round at a valuation of $20 million, the safe investor shares will be priced as if the company were worth only 10 million. This provides them with a better deal compared to later stage investors. In some cases, safes may also include a valuation floor, although this is not standard. A valuation floor sets the minimum valuation at which the safe can convert. It is designed to protect the startup in scenarios where the company's valuation drops unexpectedly, helping prevent excessive dilution of the cap table. Together, these elements help align the interests of startups and their early backers, balancing risk and reward through clear, structured terms. Startups and investors often negotiate between a discount and a valuation cap. Some safes include both, while others may have only one of these features. In scenarios where both exist, the conversion happens at the more investor-friendly of the two. For early-stage startups, safes offer unparalleled speed and simplicity. They eliminate the need for long due diligence processes, complex term sheets, or negotiations over governance rights. This allows founders to secure capital without getting bogged down in legal fees or giving up immediate control, as safes do not require board seats or voting rights. Investors, on the other hand, use safes as a way to enter promising startups early without forcing premature valuations. While they don't get the same level of control as equity investors, they do benefit from potentially significant upside if the company grows. The discount and valuation cap serve as incentives for taking early-stage risks. Despite their benefits, safes come with certain risks and complexities. One of the biggest challenges for founders is the uncertainty around dilution. Because safe conversions happen in a future round, startups won't know exactly how much equity they're giving away until that moment. If a company raises multiple safes with different terms, conversion can become complicated, particularly if some investors receive better deals than others. For investors, the lack of immediate ownership and governance rights can be a drawback. Unlike traditional equity financing, safes do not grant voting power, board representation, or any direct influence over company decisions. Additionally, if a startup fails to raise a priced equity round, the safe may never convert, potentially leaving the investor without any equity stake. To mitigate this risk, many safe agreements include a clause that sets a final conversion date, typically 12 or 24 months from signing, after which the safe automatically converts into equity, even in the absence of a qualifying financing round. Although safes are meant to be simple, investors often include terms that influence how they convert into equity, so founders need to be aware of these details. As we have already said, the valuation cap sets a maximum valuation at which the safe will convert. This protects investors by ensuring they don't get overly diluted in future rounds if the company's valuation increases significantly. Then there's the discount rate, which is a percentage off the next round's valuation. So, if an investor has a 20% discount, they'll get shares at 80% of the next round's price, basically giving them a better deal for investing early. A most favored nation, or MFN clause, is another term that benefits early investors. If the startup issues new safes with better terms in the future, investors with an MFN clause can adopt those improved terms, making sure they're not left behind with less favorable conditions. Finally, conversion triggers outline when the safe will actually convert into equity, which usually happens during the next priced equity round, assuming it meets a minimum size requirement or within the deadline specified in the contract, which is called final date. For investors, it's essential to evaluate safes carefully to ensure they align with the fund's ownership targets and long-term return expectations. While safes may appear simple, their cumulative impact can lead to unexpected dilution, especially when multiple notes with different terms are issued. As a VC, you should pay close attention to valuation caps, discount rates, and conversion mechanics to avoid unfavorable outcomes during priced rounds. Properly negotiated safes protect your upside while maintaining alignment with the company's future capitalization strategy. The decision between equity financing and safes really comes down to where the startup is in its journey and what kind of fundraising it needs to do. If a startup is at the Series A stage or later, it's more likely to pursue an equity round. At this point, the company typically has enough traction and growth to justify a valuation, and as investors, we expect more formal terms, things like voting rights, board seats, and stronger governance protections. While this process can take longer, sometimes several months, the structure and clarity it provides are well worth the time and effort from our perspective. For startups in the pre-seed or seed stage, a SAFE can often be the more practical instrument. SAFEs allow early-stage companies to raise capital quickly without entering into complex negotiations. Since SAFEs don't require setting a valuation immediately, they offer flexibility for founders who are still in the early stages, and from the investor's side, they allow us to back promising teams quickly, secure allocation, and delay valuation discussion until more data is available. The process is also much faster, often closing in days rather than the months equity rounds require. Choosing between a SAFE and equity financing ultimately depends on the startup stage and the kind of capital structure that aligns with our investment strategy at that point in time. A SAFE makes sense early on when speed and flexibility are critical and when an investor is taking a calculated risk on a team before there's strong market validation. It works well if the company lacks a clear valuation or needs to postpone setting one. The simplicity of a SAFE allows investors to move quickly and reserve their position. Equity financing becomes appropriate once a company has gained meaningful traction, established a valuation range, and is raising a more substantial round, typically at Series A or later. At this point, investors look for formal rights, board involvement, and governance protections to safeguard their investment and help guide the company's growth. Both instruments have their place, depending on the company's stage and the fund's objectives. The key is to use the right tool at the right time, balancing speed, risk, and control in a way that supports investors' portfolio strategy and long-term return potential. While SAFEs are a great tool for early-stage fundraising, they are not a long-term solution. Eventually, every venture-backed startup must raise a priced equity round to establish structure, governance, and investor alignment. Investors should view SAFEs as a strategic bridge to formal financing, not as a permanent substitute for structured equity. It's important to balance the flexibility and speed of SAFEs with the need to protect the equity position in future rounds, especially as dilution risk and cap table complexity increase. In venture capital, selecting the right funding structure is just as important as deploying capital, because how a startup raises money today will directly impact ownership outcomes, governance dynamics, and the fund's long-term return profile.